Welcome back to Trendlines over Headlines, the show where we break down the markets with some of the best traders and analysts out there. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Joining me today is JC O'Hara. JC is a technical strategist at Roth MKM. As a sell-side analyst, JC talks to large market players on a daily basis. So he's got a unique vantage point, and we're really lucky to have him today. But before we talk to JC, it's Friday, the markets are closed, so let's take a quick look at how this week played out. Stocks were mostly lower this week. The Dow was the only major index that closed higher, gaining a little more than 0.5%. The Russell 2000 and the NASDAQ lagged, with both falling about 1.5%. Now, taking a closer look at the S&P 500, it fell just 1/3%. We closed right at that rising 50-day moving average, so the uptrend is still intact. It's pulled back about 3% in the past 2 weeks after being rejected at those March 2022 highs around 4,600. That's really the last major resistance level to clear before testing all-time highs. So 4,600 is the next upside objective to watch in the near term. To the downside, keep an eye on last summer's highs around 4,300 for potential support. That's about 2.5% lower from here. Now, taking a quick look at the sector performance from this week, 8 of the 11 sectors closed higher, so a little bit better than the index level. Energy led for the second straight week, gaining about 3.5%. Healthcare also had a decent week, gaining about 2.5%. On the other hand, tech was the laggard, falling about 2.5%. Anyway, that's enough from me. Let's bring in our guest, JC O'Hara, to see what he thinks. All right, JC, welcome to the show, and thank you for joining us today.
Thank you for having me. Very excited about this.
Yeah, no, we last saw each other at the CMT Symposium. What a great event, right? It was the 50th anniversary of the CMT Association, and got to see a lot of legends, Ralph Acampora, Bob Farrell, all the greats. We got to go down to the stock exchange. That was a lot of fun, too. So that was, great catching up with you there. How's your summer been?
It's amazing. It's flying by. You have these plans for the summer, and next thing you know, it's Labor Day. Kids are back to school, and you're getting your winter clothes out. So trying to enjoy just the last few weeks of summer.
Yeah, just flies by every single time. But before we dive into the market stuff, I just want to touch on your background real quick, just for our viewers who might not know you. So how did you get into technicals in the first place? And tell us a little bit more about your day-to-day role at MKM Roth.
Absolutely. So at school, I went to Rutgers University, studied business, studied econ, learned how to value stocks. I was trying to go down that fundamental path, like the majority of the people on Wall Street, do. Came out of school, and my first job was at Lehman Brothers. Well, I was actually at Neuberger Berman, but it was when Neuberger Berman and Lehman Brothers were joining together. And I was there, and I was working under a portfolio manager, and I was doing fundamental analysis on companies, right? So I was the one, staying late, there early, making the coffee, getting lunch out. I was doing everything. And one day, I finished an analysis on a company that we were researching, and I went into my portfolio's manager's office, and I said, found this company, really like it. I think this has tremendous upside. It's growing. It's great. He looked at my work, and he said, JC, I absolutely agree with you. And I said, oh, this is great, because I'm a young kid, and, finally somebody is giving you a little respect and, appreciating the hard work you're putting in. And I said, all right, so are we going to buy it for our portfolio? And he said, absolutely not. And I was shocked. I said, what do you mean? You just agreed with me that this company is growing. The price target is, 2x where it should be, or where it is right now.
And again, you wanted this stock because of the fundamentals?
Fundamentals. I was a fundamental guy. That's all I knew at the time, fundamentals. And he said, well, yeah, but if you look at the chart, and I said, look at the chart. Okay. He goes, you see, it's been declining over the last few weeks. I said, yeah, so we're getting it at a great price. He goes, yes, but what if it goes down another 20%? And I said, I'd never thought about that. So all of a sudden, that conversation about, timing and entry and looking at the chart, that was my first real experience with technicals. Later that week, he took me to the Lehman Brothers trading floor. And I mean, this floor was tremendous. It was large, bells and whistles, people yelling, screaming. And what I found was when you walk behind the traders and you looked at their screens, right, they didn't have up, Excel sheets with fundamental inputs. They all had charts up. So there was just something in finance that I never had an experience with. And all of a sudden, these guys looked exciting. They were looking at something completely different than I was looking at. And I said, I need to learn more about this. So I started studying technical analysis, read all the books, took the test, got my CMT designation. And I liked it so much. And I actually thought it had much better value. It really resonated with me more than fundamentals, that I left fundamental analysis to become a full-time technician. And I'd worked with some great technicians over the years, but it was at that point where, my Wall Street career went from fundamentals to technicals.
I love it. I love it. And I love hearing, people's backgrounds and how they stumbled into it. I think you end up finding a lot of common themes like that. But anyway, so tell us a little bit more about what you're doing now at MKM.
Yes. So what I do is I'm the technical strategist here at the firm. First and foremost, I work with our macro strategist, Michael Darda. I work with our derivative strategist, and we try to come up with high level, macro ideas and thoughts. And obviously, my input is coming from the chart world. And I compliment our economist, and he really respects the charts. So it's a great combination of ideas. Sometimes we agree, sometimes we don't agree, but a lot of times our clients want to see that, right? They just don't want to say, oh, they always agree, they always have the same call. Sometimes, especially this year, is a great example. The market was telling us we should probably be a little bit more bullish and aggressive in our portfolio versus what the economists and forecasters were telling us, right? So I think having that dialogue really helped. And then my favorite part about being a technician is that grunt work of going through hundreds and thousands of individual stock charts. Right?
You like the grunt work. I like that. Yeah.
It's a burden of love, right? It's something that, takes hours, but if you don't do it, you really don't have a feel for the market, right? That's how I really, value technicals, right? You put in the blood, sweat, and tears, and that means going through thousands of charts. And at the end of that exercise, you always find something new. You always start looking at the world slightly different. And by doing that, I'm putting new ideas or new thoughts or just new questions in front of clients. And, they appreciate that. So, that's kind of, a high level picture of what I do day to day at Roth MKM.
Yeah, I like what you said there about, the value you get from just looking within it. I mean, looking at a chart of the S&P 500, that's great. You can get a lot of information from it. But when you dig down into the components and you look at, some of the big ones in there, like the Apples and the Microsoft, it ends up making you ask some questions, right? Like if Apple, for example, right now kind of looks like a failed breakout, you got to ask, okay, so what if we lose Apple, right? Just that process of digging in and looking through all the components can give you a lot more than just looking at the index itself, right?
And I'll tell you, I mean, and I think you will agree with me, this year, I've had more questions than answers, right? Sometimes they come to us because, we expect to know everything about the charts and, what is that chart telling us where the market should go, or, what is the dollar doing? What is crude oil doing? But this year, because we're in the middle of all these different cycles and things aren't aligned like historic analogs would suggest they should be, all of a sudden you're asking questions. But I think that's even more important, asking the right questions, because when you ask a question, then you start to make observations. And when you start to make observations and you start to see things slowly work one way or another, you start to answer questions. But sometimes you wouldn't be able to answer the question if you never asked the question, right? So, I think this year it was just full of questions and questions and questions, and you don't necessarily know the answer. We don't pretend to know the answer in real time, but the market kind of slowly gives you answers if you're patient and you're willing to listen to it.
Right. I mean, all this reminds me of a quote from Mark Ungewitter. I might butcher it here, but he said something like, "Charts don't give you answers; they give you questions, right? And enough questions will lead you to an inference, right? To it'll if you're asking the right questions, you'll ultimately arrive at an inference, a good idea. But anyway, let's dive into the market stuff. We got a lot to cover. We're recording this on Thursday, August 10th, so the week isn't quite over yet, but so far we've been in pullback mode these last 2 weeks, really. It all started with that nasty outside reversal. I think it was a Thursday.
Yep.
And then that Friday we rebounded a little bit, but then we never regained that high. I think we just kind of have been drifting a little bit lower, not too sharp. But what do you think of this pullback so far? We'll start off with the S&P 500. What levels are you watching, or maybe
Well, I think this
indicators?
pullback so far has been a little frustrating for both the bulls and the bears, right? Because if you're bullish, the market just can't seem to find footing, right? There's no high conviction level right around here where the bulls will say, if it pulls back here, I want to jump all over this and buy it. And conversely, for the bears, you would suspect when you start losing leadership, when you start seeing increased volume on down days, distribution days start piling up across the S&P, the Nasdaq, you would suspect that this pullback would have been a little bit faster, a little bit deeper,
Yeah,
and you're just not getting it. So I don't even know if I want to say it's a pullback just yet. It's kind of a pause, a consolidation. We're 3-4% off all-time highs. But if you look at the market, you could see that the characteristics are changing, right?
right.
Right. Over the last 10 days or so, you're seeing a bunch of days where you come in, the futures are up. The first hour or two of trading, we're slowly advancing, moving higher. And then traders, portfolio managers come back from lunch, East Coast lunch, Patrick, and you start to see selling pick up on that 1-2 o'clock hour. And then, that final minute or two of the day, we're getting huge selling balances. So to me, it's the market is slowly losing steam. And that's been definitely a change of pace than what we've seen over the last 3 months or so. So we're seeing the market slowly roll over, not enough to get, a lot of chart watchers convinced we're going to have at least a garden variety pullback, but we're noticing some changes.
Yeah, you had that chart there of basically showing that last hour, the last half of the day has been kind of weak lately, and that's been a new phenomenon, or at least something we haven't seen this year up until this point. Is that correct?
Absolutely. And one of my most trusted indicators, and it kind of deals with money flow, but also supply and demand and fear and greed. And I know a lot of technicians don't use it, but I find it incredibly valuable, is what we call the tick index. And
Yeah,
the tick index, it's very simple, but it's the heartbeat of the market. And what it does is every second of the day, it tells you how many stocks on the NYSE are trading on an uptick versus how many stocks are trading on a downtick. And if you look at it, it's kind of a squiggly line, right, over the course of the day. But there's so much value in there if you know how to use it. And again, there's multiple ways how to use the tick indicator. One way I do is just looking at the closing tick each day, smooth it out a little bit over 10 days, 20 days, 30 days. And you could see the most important time for me is that 3:59 minute, because that's where large only mutual funds are interacting with the market, right? These are the guys who can actually move the market up or down if they're buying and selling. So by
right.
looking at what happens in the last minute of every day, and again, smoothing it out, you could tell, hey, is money coming into the market? Is there more demand for stocks, or is money coming out of the market? And what I found over the last 7 days, that smoothing tick index has rolled over. That has been a pretty good indicator that we are at least at a short to intermediate term top, right? This is not calling for a bear market 20% correction, but this is calling for an intermediate term top. And this started rolling over even before the market did. So this is something I'm continuing to watch. And today, Thursday, market closed on its lows, right? So that trend is continuing.
Yeah, after a little rebound too, we were up at least 1% this morning after those CPI numbers were released, I think. But
And
kind of a
and the
nasty
futures,
reversal candle.
we made a new 5-day high intraday. but we weren't able to hold that, right? So all of a sudden, sellers emerged, pushed the market lower, and then some
Yeah,
indices, not all of them, but some of them actually undercut the prior session's low, right? Small caps undercut it. So that's showing me, hey, if small caps are leading to the downside, that's probably going to pull some of these larger cap indices as well.
yeah, I always thought the tick was more just for day traders and stuff. So it's interesting to see how you use it, and also that we're continuing to see kind of that slump into the close, even today, right? Uh, but
Absolutely.
and you also had in that chart, you also had the range was getting real tight, right? Before we saw this newfound weakness.
So if you look at session ranges, equity markets cannot move lower when ranges are this tight, right? They simply cannot. What often happens, and again, this goes into the psychology of technical analysis, right? What are we trying to measure? We're trying to measure humans. We're trying to measure greed. We're trying to measure fear. How do we measure that? Well, there's plenty of ways to do that. But one way to use that information to call markets top turning points, tops and bottoms, is to look at session ranges. Because what we found is after you've been in an uptrend or a downtrend, those session ranges become pretty narrow right before turning points. And then what happens is you start to see an interaction between the bulls and the bears, and they start jockeying for control of the market. And what happens is that creates these wide session ranges. But at the end of the day, the market really doesn't move anywhere. But that shows you that there's a power shift from from the bulls to the bears or vice versa. So over the last few days, we've slowly started to see a very narrow range market increase its daily session ranges. So that to me tells me under the surface there's a war taking place. There's a major battle between the bulls. They want to keep control of this market, and the bears are becoming much more aggressive at these levels. And these create these wider ranges. You combine that with a tick reading that's rolling over, showing the sellers are really becoming aggressive. And all of a sudden, you have a case to be a little bit more conservative or expect further downside in the days to come.
Yeah, I mean, it's like that classic saying, from range contraction comes range expansion, and we've seen that play out in the last couple of weeks. But staying on the topic of market psychology, I want to get your read on sentiment. This chart comes from Callie Cox over at eToro. I've been sharing it almost every episode and asking my guests to point to where they think we are on the cycle. I think it's a good exercise, and I always like hearing everyone's answer. Obviously, there's no right one, but anecdotally, from everything you're seeing and everyone you're talking to, if you had to point where we are on this chart, where would you say we are in that kind of classic sentiment framework?
Well, going back to what we were talking about briefly earlier about this market and this economy, the stock market's not the economy, right? And they're two
Right.
separate things, but they usually kind of act and move in somewhat similar fashions. So if you were to simply look at the economy, and the majority of market participants who study economics, they are still suggesting a recession is coming. Obviously, they're kicking out their recession due date. But if you were to think about that and then say where the market is up 30% from October, testing old highs, you would probably want somewhere say you're near euphoria, right? You're near this max optimism. But looking at other sentiment indicators, just looking at stocks now, I would say we're somewhere in that belief camp, right? If you look at, what people who look at price action are thinking and saying, I think they're believing now that the soft landing scenario is going to happen, right? If you look at Google keyword searches, soft landing at the highest it's ever been in the last decade, right? So I think the soft landing narrative is taking over. So I think we're probably somewhere between that optimism, belief. I don't want to say we're at euphoria right now, but I think we're having a belief now that the stock market is in a bull market and a soft landing scenario is achievable. Something that was not, in the cards at those October lows.
Yeah, I mean, it does seem like there's been sort of a shift in crowd psychology these last few months, few weeks. You saw, some of the most bearish strategists come out and kind of capitulate and kind of, give that mea culpa. And so that kind of is reminiscent of maybe, like you were saying, the belief stage where, people are starting to say, okay, maybe we are in a new bull market. And I think there's probably an element of sentiment that works in different time frames. You know what I mean? Like,
Yes.
there, you know what I mean? So like short term, you can get euphoric, and maybe we saw that. But then you think about it longer term, and where are we coming from? We're coming from the most pessimistic levels since '08, right? So in that context, it's a little different. Do you think there's any truth to that?
There is, right? And I think it also, when you say sentiment, you said there's different time frames. I agree. Sentiment is also for different market players, right?
True.
So, let's just take the average Joe. All of a sudden, the average Joe, their sentiment is directly correlated to their P&L of their stock account or their 401ks or their IRAs, right? So they're up 20% this year, right? Their equity portfolio, they're pretty optimistic, right? But then
Yeah.
you look at another market player, hedge funds. For the first 5, 6 months of this year, hedge funds were not believing in the equity rally, right? Some of the
Right.
smartest.
You had that massive short position. You remember that? I think that's been unwound since, but that was there.
And that I would say that took place probably over the last few weeks, right? We're seeing these short squeezes. We're seeing short positions within tech funds being shrunk. They've become aggressively long technology, almost to the point where that's worrying me, right? If you look at some of the largest or names that hedge funds own the most, 40 or 50% of that basket is in technology, right?
Oh,
Where the
wow.
S&P is 25% technology, right? Give or take. So you're seeing hedge funds closing shorts and really making massive, sizable bets on technology. And when you start looking at that, now we're saying short-term sentiment, we should probably be getting a little cautious of tech right now, because if they start to unwind that position, there's a lot of money to be coming out of that little mini bubble.
Right. And so break down this one real quick. So this is sentiment and exposure. What were you using for your inputs there?
So I use there's plenty of ways to measure sentiment. This chart in particular, you're looking at the AAII bulls, bears, and neutral ratio, and it finally bumped up into levels where we suggest that sentiment is becoming a little too frothy.
Hmm.
Doesn't mean that it has to pull back, but traditionally these are levels that it pays to be a little cautious. And then for exposure, I found the NAAIM. So the active investment managers. Each week around Wednesday or Thursday, they come out and they poll thousands of active managers, and they basically say, how exposed to stocks are you? Last week, they were 102% exposed to stocks, right? What does 102% mean? Well, now they're actually using leverage to go long, right? And that is the scariest number to see. So when they're using leverage for the upside with
That's
extreme
chasing,
sentiment
right?
readings, you just have to question. And again, sentiment's not a timing tool, but you have to start questioning where the incremental dollar is going to come from to keep this market moving higher when you start seeing readings off the charts like that.
Right. And of course, this chart is a week or two old. So, and I think we got the latest numbers either yesterday or today for the AAII. So maybe they've come down a little bit, but
Not
certainly
to,
coming from a place that was pretty elevated, right?
they pulled down a little bit, but not enough to make me comfortable again. Put it that
Oh,
way.
did you check it out today? Did you?
Yeah, I think AAII bulls dropped to 47%. So it's still around half the market is still bullish, which is up there. And
Is
for the
it?
exposure numbers, they dropped to 97, 98%. So they're no longer leveraged long, but that they're still pretty darn exposed to stocks.
Yeah, I mean, I someone would have to go back and check, but I feel like this is probably the first time sentiment's dropped in quite a few weeks. Again, somebody
Yes.
would have to go back and check, but it wouldn't be surprising given sentiment usually follows price there. But you mentioned tech and some of the sketchy looking charts within there. Right here we have XLK, the tech sector ETF. Like you mentioned, it's 25% of the S&P 500. A lot of people are positioned within tech because it was one of the first sectors to broke out last month. But here we are. That breakout's kind of failing. Is it too early to call it a fail breakout? I know the week isn't over just yet, but what do you think?
You ask hard questions with a trading day left, so I could be very easily be wrong.
Right.
When you look at the chart, right, it broke out, convincingly broke out. Now it pulled back. Technical analysis 101 says you break out, chances are you're going to pull back, test that breakout area for support. So we're sitting right there. So maybe a tad too early to call it a false breakout. When you look at the equal weight S&P 500 tech sector, you're still 5 or 6% underneath those January 2022 highs.
Oh, so it never broke out.
But what's equally as interesting, and I don't know if this is the right way to do it, but it's something I was just playing around with. If you look at the equal weight S&P 500 tech and you combine it with the cap weighted tech, you are exactly at that breakout point. You're sitting right there. So again, I don't know what that means, but I'm watching that to see if that rolls over or if that continues higher.
So maybe we don't call it a failed move just yet, but maybe we just say it's running into overhead supply.
Well, also you have some of the biggest names in there, Apple and Nvidia. They've already corrected 10%, right? So the fact that the XLK is holding up right here with the main drivers of its returns year to date, that tells me that some of the lower market cap names are actually doing heavy lifting right here. So that is a positive. So I don't want to be too negative, right? If I told you Apple is down 10%, where would XLK be? You would probably say it would be down close to 10% as well, right?
Yeah. And of course, tech was the place to be in the first half of the year. But here we have the second half performance so far, basically since the start of July. And energy, I mean, it's up almost 9% there. Meanwhile, tech is at the very bottom. It's almost like the sector performance profile was flipped on its head from the first half to what we've seen so far in the second half. So energy just really, really picking up in the second half. Do you think that continues? I know a lot of people are watching that sector and expecting to see some sort of pickup because it just took really the last year off. It peaked last summer along with crude oil and stuff, and then just kind of paused for the last year, and here we are picking up again. So what is your outlook on energy right now? And would you, over the next 3 months, over the next quarter, would you rather be in energy than tech?
So I'm going to say something, and forgive me, this might be, blasphemy for, a technical conversation, but I started on the fundamental side, and some of my process is fundamentally driven, right? Because if we look at supply and demand occurs at a price. A lot of times that price is dictated off of fundamental analysis, right? That's fine. I don't want to say it's wrong. I try to combine both studies. What I found interesting is the earnings season. It's not over yet. 450 of the 500 S&P stocks reported. If you look at energy and you look at technology, on aggregate, tech names or tech companies have outperformed. They've jumped over expectations, but their stocks were down 1% on average the following day. Energy stocks performed in line with expectations. Their stocks were up. So that tells me that we might be in a situation today, this earnings season, where technology is priced to perfection. And even good news that we've been seeing coming from earnings is not enough to keep that uptrend that they've established going. So now you're getting into a point where fundamentals are saying, hey, maybe tech is expensive, so maybe it'll behoove me to take profits. Energy, I'm underallocated to, and if I'm completely honest, some of the best looking charts are energy charts. Maybe that is where that new incremental dollar should be devoted to, right? And then we start getting into that rotation where leadership does change. So I think there's a very good probability that energy outperforms tech over the next few months, right? And again, I'm saying that because I am a chart watcher, and you see some of the charts that are, that are on straight 45-degree lines that can't be sustained. They're parabolic in the technology space. I think that they have to come back to life a little bit. They're stretched structurally. I think there's still plenty of room for tech to run, but we're in the, this tactical, the conversation where you're probably going to see some rotation into energy, especially if you're looking at technical formations and construction of charts. That's where you want to be. OIH, look at that chart. Beautiful.
Yeah. And I think that's really interesting how you're looking at the differences in reaction to those earnings. And, I think we could chalk it up to technicals. We're talking about the market's reaction to it, right?
Exactly.
But here we have it, turning right at a logical level at those 2000, the trough from 2000. This is, of course, the ratio of energy to tech. And that little turn there, that is that outperformance that we're seeing right here, because that was a very long-term chart. But what's amazing, JC, is you zoom out a little further and you look at the 3-year performance of the sectors, and energy is just really in a league of its own. And yeah, it's taken the whole year off, but pretty much since COVID, since the pandemic, we've been living in an energy world, basically, right?
And we've been living in that world without the help of Europe, without the help of China. So if you were to tell me China goes offline and Europe is on the verge of a recession, you would say, all right, crude oil, Brent, you'll probably see that drop into the 50s, 60s. Crude oil hasn't been well the first half of this year, but it kind of stopped moving down, right? It kind of started basing. And to me, if there's no fundamental macro catalyst, but it's kind of finding a floor, to me, all of a sudden, I'm interested in that. And
yeah, and
I'm sorry.
Sorry, go ahead.
We talked about market players, right? And understanding who's interacting with the market. I think one of the biggest players that, people really don't talk about because they don't understand, because, they hide behind black boxes, are CTAs. And as technicians, we are CTAs, right? We are trend followers at nature. But CTAs are quantitative. They have all their strategies in their box, and they have, they spit out, am I a buyer of this or a seller of this? And they typically interact with major liquid asset classes, E-mini futures, the dollar, crude oil. And what we found was the first half of the year, these trend followers, who again control massive pools of money, they were short crude oil. Mid-July, they received their first long signal. So now all of a sudden, you're seeing these major shorts start to close and long positions take place. That has helped crude oil break above the 200-day moving average last week. And today, flirting with the 52-week high. So now all of a sudden, you're having a commodity providing tailwinds to energy equities. So I think that's a great 1-2 combination. And we don't even have to talk about the dollar yet, right? If the dollar goes lower, that's another tailwind for crude, which is another tailwind for energy equities.
Right. And, we're just coming off of an 8-month high. As you said, it reclaimed the 200-day, I think, last week or so, but it definitely looks like it's trying to reverse higher. But, you had mentioned how energy stocks are reacting to, somewhat inline earnings, and they're reacting positively, or at least better than tech. And another thing is, when crude oil pulled back last summer and, up until this year, you saw energy stocks pretty resilient, right? I mean, they didn't break down in the way that you might think they would. Were you seeing the same thing? I mean, you mentioned OIH. That one was one that stood out to me as kind of an area of relative strength within the sector.
That and the largest players, right? The Exxons, the Chevrons, those sort of names, because they make money. And again, I don't want to get too fundamental. They make money if crude's above $40, right?
Listen, if there's one person I trust talking fundamentals, it's you. So you go ahead.
So now all of a sudden, crude is north of 80. So those guys are making more money. But what's important is look at the energy and look at it in terms of market cap. So people were hiding in these large major integrateds because they know they're going to have a dividend. They're not going to move down that much because they're still making money, not as much money as they are now, but they're still doing fine. Look at large cap energy relative to small cap energy recently. Small cap energy is seeing the inflows right now. So crude going forward with small cap energy outperforming large cap energy, that just shows you that the risk tolerance for energy stocks is blowing up right now. Look at a name, SM Energy, a small cap energy stock. To me, that's probably one of the better, best looking energy names out there. Bearish to bullish reversal, breaking above key moving averages, breaking right through levels of resistance like they're not even there. So to me, small cap energy offers plenty of opportunity right here.
Yeah, and the whole sector, from what we've seen, it was very strong last year. And before this run over the past 2 years, energy was a tiny, tiny weight in the S&P 500, and I think it's doubled in size in terms of weighting in the last few years. But another tiny sector that kind of gets left for dead, materials. I know this is a sector that you've been watching lately, and some other smart technicians I follow have also been watching the materials sector and kind of looking for a potential rotation in the second half of the year. It kind of has similar tailwinds to energy, right?
It does. But let's remember also materials, there's so many different subsectors, right? You have gold, you have chemicals, you have building supplies, right? So materials itself, though it's a small sector, there's so many different individual levels underneath the surface that are grouped as materials. But what we're seeing is some of the offensive risk on cyclicality sort of material names, they're doing pretty well. You might not actually see it appear on the surface of materials because you're fighting against names like gold, right? Or like gold and gold miners, where they're not the best looking charts right now. So we might actually have a situation where materials on a top-down view doesn't do too much, but there's pockets of materials under the surface that if this market does indeed decide to move higher, that there's some really offensive ways to play materials through some individual charts out there.
So what industry groups within materials? You mentioned it's a pretty diverse makeup within materials. So what industry groups do kind of have your eye right now?
I'm really looking at chemicals. And I'm saying that because over the last few days, chemicals have been extremely weak, right? Same thing with steel, right? If you look at steel names, they're slowly starting to roll over. So again, this comes down into, what time are we talking? Short term, I think what you're seeing from chemicals, what you're seeing from steel names, what you're seeing from copper names is a market that's probably going to take a step back, right? These are leading indicators for the market that are pulling back. What I'm looking for is when do they stop moving down? When do they find support? Because if they roll over before the market, they should recover before the market. And if we catch that turn and this market does finally decide to move higher into the end of the year, I think we're going to have a great opportunity to tactically play these structural pullbacks within the sector.
I see that makes a lot of sense. And any particular one within chemicals? I mean, the only chemical stock I can think of is like Dow, DuPont.
Those are fine. Play the biggest ones, right? That is completely fine. Also, I think look at some of the steel names, because what is concerning me a little bit is what iron ore is doing. Look at copper, right? Copper to me doesn't look too healthy. It's kind of consolidating, right? Long-term consolidation is taking place.
It just hasn't done anything. I mean, it's just kind of trendless, right?
And this is one of those things, you can't wish something on the market. You sit back and let the market tell you what it wants to do. I remember Frank Teixeira, you know him.
Yeah.
I was meeting with him one day, and I was still very young in my technical career.
I love a good Frank story.
And I'm sitting in his office. Dave Lundgren is there at Wellington, and I'm nervous. What am I going to tell these guys? They know everything, right? And I'm like, well, Frank, I think this could happen, and I think this is going to. And he stops and he goes, JC, stop. He goes, the biggest service you could do to me and the biggest service you could do to your clients is just tell me what's happening right now. Tell me what's happening today. People are so worried about forecasting and looking for something in the future that they miss what's happening right in front of their face. And I think copper is a great chart, right? If you're bullish on the economy, you're bullish on the macro, you see this as a chart that's going to break out. If you're bearish, you see this as a chart that's going to roll over.
Right. It's
I'm
like kind of
telling you,
pick your own adventure.
it hasn't made that move yet, right? So
Right.
I don't know what's going to happen, but I'm prepared and I have my playbook ready for if copper breaks out versus copper breaking down. So I'm telling you what's taking place today, and then I'm going to be patient and see when this breaks, then you make the trade.
Right. I mean, it's required a lot of patience. I saw somebody recently point out, obviously, copper is kind of looked at as this leading indicator, especially for the economy, but also the stock market. And somebody was saying, hey, copper's been telling us since last year that we're not going into recession. It's been making these higher lows. And I thought maybe that was a stretch because, it hasn't been trending higher. It's really gone nowhere. But the fact that it didn't break down at least told you that, if we were going into recession, you'd probably expect it to be breaking down more than it is now, right? I don't want to get too deep into that whole thing, but yeah, I mean, do you have any thoughts on that, or do you have any conversations with your economist counterpart at MKM about copper? Does it ever get brought up?
Absolutely. I mean, you look at copper and it has a tremendous track record of being a leading indicator to the global macro, right? So, yeah, it wasn't uber bullish, but to your point, it wasn't breaking down and it wasn't bearish. But wasn't that kind of what the market was doing this year, right?
Right.
You know bull market characteristics, right? You can make a list of 20 things that happen in bull markets. You can make a list of 20 things that happen in bear markets. And I could say, yeah, maybe we have that or have that, but it didn't look like a bull market, didn't feel like a bull market, didn't look like a bear market, didn't feel like a bear market. And copper kind of was telling you that exact same thing, right? It wasn't tipping its hand, and that's kind of what the market was telling us as well. So I think the copper chart again proved its value here this year.
Yeah, and I guess it was kind of this like weird thing where we weren't even sure if it was a recession or not. We had people debating the definition of a recession last year and all that. JC, I think we're running out of time. Thank you so much for coming on. I had a lot of fun, and it's always a pleasure talking to you.
No, thank me. Thank you. Let's do this again.
Oh yeah, of course. And I owe you a steak next time. Next time I'm in the city.
Sounds. I'll take you up on that.
All right. Well, have a great weekend and enjoy the rest of your summer.
You too, Patrick. We'll talk to you soon, pal.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.